On the morning of December 2001, the seventh largest company in America filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history. 20,000 employees lost their jobs. More than $1 billion in retirement savings evaporated. And on Wall Street, some analysts were still calling the stock a buy. But here's the part nobody talks about. 3 weeks earlier, inside an accounting office in Houston, the shredders were already running. All night, every night. Enron didn't collapse because of one bad quarter. It collapsed because for years, the numbers everyone trusted were fiction. This is the autopsy of the smartest company in the room. And it starts with a single accounting trick. One so elegant, the regulators approved it themselves. To understand how it died, you have to see how alive it looked. Enron was born in 1985, when two pipeline companies merged, Houston Natural Gas and InterNorth. Its business was about as boring as business gets, moving natural gas through steel tubes. Its chairman, a Houston economist named Kenneth Lay, had bigger plans. He didn't want to move energy. He wanted to trade it. In 1990, he hired a McKinsey consultant named Jeffrey Skilling. Skilling's idea was simple and genuinely brilliant. Turn natural gas into a financial product, a gas bank. Buy contracts, sell contracts, trade the future itself. It worked. By the late 90s, Enron wasn't an energy company anymore. It was a trading machine bolted onto a pipeline. Fortune magazine named Enron America's most innovative company. Not once, 6 years in a row, from 1996 to 2001. In August 2000, the stock hit $90.75. The company reported over $100 billion in revenue for that year. 7th place on the Fortune 500. The market value peaked near $70 billion. Analysts didn't cover Enron. They worshipped it. Inside, the culture matched the stock price. Enron hired the smartest people it could find, ranked them against each other twice a year, and pushed out the bottom of every ranking. They called it rank and yank. It built a company where the most dangerous thing you could do was ask a question that made the numbers look bad. Because here's the thing about those numbers. Years before the collapse, at the very root of the empire, something had already gone wrong. In January 1992, the Securities and Exchange Commission approved Enron's request to use a special accounting method for its gas trading. Mark-to-market. Here's what mark-to-market meant in Enron's hands. Sign a 20-year energy deal today, estimate every dollar of profit it might ever produce, and book all of it, today. Not when the cash arrives, not when the power flows, the day the ink dries. And who estimated those future profits? The same people whose bonuses depended on the estimates. Think about what that builds. Every quarter starts at zero. Yesterday's imaginary profit is already booked. So, you need a new deal, bigger than the last, just to stand still. Mark-to-market wasn't illegal. The regulators signed off on it. But in a culture paid to imagine profits, it was a loaded weapon left on the table. Paper profits piled up. Real cash didn't. And the gap between those two numbers became Enron's deepest secret. Secrets that size need somewhere to hide. In 1998, Enron promoted the man who would build the hiding places, Chief Financial Officer Andrew Fastow. Fastow created a web of partnerships with names like LJM, Chuco, and the Raptors. On paper, they were independent companies. In reality, Enron controlled them. Their job was simple. When Enron had a bad asset or an embarrassing debt, a partnership would buy it. The debt didn't disappear. It just disappeared from the balance sheet. Billions of dollars of risk parked just out of sight, with Enron's own stock propping up the whole structure. The board of directors knew about the conflict of interest. Twice they voted to waive their own ethics code so their CFO could run the partnerships that traded against his own company. The Powers report later found Fastow made at least $30 million from those partnerships for himself. And Wall Street? Wall Street applauded. The structure was too complicated to question. At Enron, complicated was the point. Almost no one asked the simple question, until a reporter did. In March 2001, Fortune's Bethany McLean published a piece with a 5-word title, Is Enron Overpriced? Her question was devastating precisely because it was basic. How exactly does this company make money? The next month, on a public earnings call, an analyst pressed Skilling on why Enron couldn't produce a balance sheet with its earnings. Skilling thanked him. Then he called him an obscenity. Live. To the entire market. When a CEO answers a math question with an insult, the math is the problem. There were other warnings. Billions torched on international projects that never paid off. And in California, rolling blackouts, while federal investigators later documented Enron traders gaming the state's power market. The tapes of those traders exist. They laughed about it. Remember that when we get to the verdict. 6 months before the end, the captain jumped. August 14th, 2001. Jeffrey Skilling, CEO for just 6 months, resigned. He cited personal reasons. Prosecutors later showed he had sold roughly $60 million of his own Enron stock. Days later, a vice president named Sharon Watkins sent Kenneth Lay a memo. One line survives everything. I am incredibly nervous that we will implode in a wave of accounting scandals. Lay reassured employees. Publicly, the message stayed the same. The company is strong. The stock is a bargain. Then October came, and the floor gave out. October 16th. Enron announces a $618 million quarterly loss and quietly reduces shareholder equity by $1.2 billion. Journalists start pulling the thread of Fasto's partnerships. October 22nd. The SEC opens an inquiry. October 24th. Fasto is out. That same month, the company's retirement plan entered an administrative blackout. For weeks, employees couldn't touch their 401k accounts. They watched the stock fall through the glass. For many of them, that account was almost everything. At the end of 2000, 62% of the plan's assets were Enron stock. November 8th, Enron restates its books. Nearly $600 million of profit since 1997, gone with one filing. It was never real. A rescue merger with rival Dynegy flickered for 19 days. On November 28th, the rating agencies cut Enron to junk. Dynegy walked. The stock closed at 61 cents. December 2nd, 2001. Chapter 11. 16 years to build. 24 days from the SEC inquiry to the filing to fall. And in Houston at the auditor's office, the shredders finally stopped. The paper was already gone. So, autopsy time. Cause of death? Not one wound. 3 organs failing together. Mark to market let Enron imagine its profits. The partnerships let it hide its debts. And the culture paid everyone involved to never say the quiet part out loud. Now the part the jury always asks, who profited? In the years before the collapse, Enron insiders sold more than $1 billion of their own stock, according to shareholder lawsuits. The people who built the fiction cashed out of it. Kenneth Lay was convicted on every count in May 2006. He died 6 weeks later, before sentencing. His conviction was erased as a matter of law. His victims got no verdict at all. Jeffrey Skilling, convicted of fraud, conspiracy, and insider trading. Sentenced to 24 years, later reduced. He walked out in 2019 after serving 12. Andrew Fasto, the architect, pled guilty and testified against his bosses. 6 years. Today he gives paid talks about corporate fraud. The man who built the hiding places now sells the map. And who paid? 20,000 employees. Retirement accounts built over decades. Shareholders holding roughly $70 billion of value that stopped existing. Arthur Andersen, the auditor that shredded the evidence, was convicted of obstruction in 2002. The conviction was overturned 3 years later. Too late. The firm was already dead, and 28,000 American jobs died with it. Congress answered with the Sarbanes-Oxley Act. Since 2002, CEOs personally certify their company's numbers. Because of Enron, a signature can now put a chief executive in prison. The tower still stands in Houston. Different name on the door. The skyline never mentions it. They really were the smartest guys in the room. That was the problem. Everyone was so busy admiring the intelligence, nobody audited the arithmetic. So here's the pattern. For your own files. When a company's profits are a story about the future, and its cash flow is a secret about the present, that gap is the crime scene. every time. You've seen this pattern since Enron. You will see it again. The names change. The arithmetic never does. 16 years to build, 24 days to die. And that's how $70 billion became a sunk cost. This file is closed. The next one is already open. New collapses every week from the public record. Don't miss the verdict.